It's not the best market for us either, but it's kind of like what you're saying. If we stay disciplined, we can do well in any market.
People are talking about recession, but to me, it's like, how long have we been in this bull market? It's been so long, for so long.
Inflation is the bigger threat, and it's starting to get under control now. We're seeing signs that it's getting under control.
All right. So Darren, welcome back. It's been a minute since we've had you on the show. Super excited to have you back. Tell us what is going on from your perspective with all the data and all the analytics that you guys compile at auction.com. What's going on with the economy and where do we think is going to happen here in 2025 for real estate entrepreneurs and investors?
Yes. Great questions, Josh, and great to be back here on the podcast. I always love hearing your perspective and all the folks you're interacting with and talking to. So I'm looking forward to that as well. But I think the headline in the distressed housing market, I'll start there, which is where we live at auction.com, is the winds are shifting, and they're shifting a direction of more distress in the market. That doesn't mean we're going to have a huge wave of distress, but we're coming out of the last 5 years, a period of abnormally low foreclosure volume. And so I can talk about some of the winds I see shifting there, or I see shifting toward more foreclosure volume. That doesn't mean, every time I say that, I have to qualify that. It doesn't mean another 2008, it just means things are shifting. And then in the economy, there's just a ton of uncertainty. And housing market, I think that's the word of the day is uncertainty. We got some certainty with the election, and our buyers actually showed us that they liked the certainty that came with the election. But now with tariffs, economic recession cropping up, and still the stubbornly high inflation, I think there's a lot of uncertainty in the economy that I think we see more signs again of a recession. That's actually one of the things that is shifting toward more foreclosure volume.
I think everybody right now is wondering what's going to happen with the economy because we've never seen something like we've seen since Inauguration Day, right? Hundreds and hundreds of executive orders, all with pretty significant impacts on whether it's Doge, whether it's cryptocurrency, whether it's real estate. I know Trump had mentioned he wanted to see the 10-year treasury go down. I'm not exactly sure why, but in my world, in the commercial world, that's a big deal, right? All commercial real estate finance is built really off of the 10-year treasury, the 7-year treasury, as well as SOFR 30-day index. So SOFR, the index falls along with the Fed funds rate. So as the Fed funds rate changes, so does the 30-year mortgage rate. The 15-year mortgage rate tends to come down as the Fed funds rate comes down. And then in our world, if we're doing commercial, bridge loans or construction loans, that comes down along with the SOFR, which kind of mirrors the 30-year. But the treasury yield is interesting because if there's low inflation, then the treasury yield will come down. People want to invest in treasuries. It's the largest marketplace in the entire world is U.S. treasuries. If inflation is up, those very conservative investors, sovereign wealth funds and governments and large pension funds, they need to get a higher yield. So they demand a higher yield from those bonds. That impacts us tremendously. But really, like this whole consumer sentiment I see is flashing on your screen red. And people are just because of the uncertainty, I think, and they're not really sure what to make of all the different kind of cuts from the government, the Doge cuts that are going on. So maybe start with consumer sentiment and why is that either good or bad for real estate entrepreneurs?
Yeah, that's a great one to start with. It stands out here. It's the only red that we see. And red is, hopefully most people pick up intuitively that red is kind of bad for the economy in general. And that just started flashing red. There was this big drop in February. You can see it went from 71.7 to 64.7. So big drop there in consumer sentiment. Now, a lot of times consumer sentiment can be a leading indicator. Sometimes consumer sentiment can be wrong. People think things are going just because they don't know, uncertainty. And then once some certainty comes in, so it's an early indicator. But I think, if we started to see, and similar to that, we're seeing for the GDP now that the Atlanta Fed puts out, and I'll jump to that real quick to show you. I mean, I think that is also kind of this big shift that we saw just recently where all of a sudden that went negative. And it's an estimate. It's not locked in stone. It doesn't mean GDP is going to go negative, but it did in early March drop to negative territory for it, predicting the first quarter GDP, which when you have GDP going negative, that's the first domino of a recession. 2 quarters of negative GDP growth is the traditional definition of recession. So I think those are two big shifts we've seen recently that tell us that we could be headed toward that territory of recession. What's interesting about a recession is that it would put pressure on the Fed to lower rates. It should. The problem is if you have inflation still high, with that you enter into a period of stagflation, which is really bad. I think a recession could lead to lower rates, which is good for in many ways good for your world, good for a lot of the buyers who are buying on the auction.com platform. We see a pretty strong correlation between our buyers who are willing to buy distressed properties on our platform and mortgage rates. When those rates come down, our buyers are more confident, are willing to buy more properties and pay higher for those properties because of the financing piece of it. I mean, they're not getting the 30-year fixed mortgage rate when they're buying on our platform, but they're selling to end users who are, and so that's why it's consideration.
I love recessions, man. I mean, recessions for us have been good, like 2008, 2000 with COVID, have been good. It's an opportunity to buy, whether it's commercial real estate. The interesting thing on the commercial side is there's already distress because interest rates are so high that a lot of guys that got bridge loans can't refinance. So we're seeing distress from a number of different people, personal friends of mine, affiliates, friends, people that I know in the market, all different kind of markets are in distress for lots of different reasons. But a recession for a real estate investor can be a very, very good thing, especially when there's really still very little inventory, right? The foreclosure starts are going up, but they're still relatively low. They're nowhere near 2008, 9, 10 type of foreclosure activity. And when there is a recession, some people are losing jobs. There tends to be more inventory that hits the market. Then rates will also drop. And as rates drop, then as long as you can hold through that kind of trough, right, then there's equity on the back side of that. Because interest rates are lower, buyers are willing to pay more. It's a weird time, right? Because it's not like we saw even in 2014, 15, there was some slowdown in the market. So people are talking about recession, but to me, it's like, how long have we been in this bull market? It's been so long, for so long. I don't remember the last time we had a recession. Remove COVID from the recession. That was only like 2 months. It's been 10 years. I don't know. How long has it been?
Yeah, it's been over 10 years. I mean, the last recession, and I would take the COVID recession out of the mix because that was such a short recession. And in fact, so yeah, you go back to it the last one ended in 2009. So 15 years basically.
Holy cow. Wow.
And I actually think so the yield curve on here has been calling for a recession up until just recently. But a lot of times when the yield curve comes out of that negative territory that says there's going to be a recession, that's when you actually see the recession happen. That's a forward-looking indicator. It had been, a lot of people have said the yield curve is no longer a good indicator of recession because it had been predicting it for really almost 2 years, and no recession came. I'm of the personal opinion that all the stimulus thrown at American consumers and taxpayers and homeowners, for that matter, during COVID helped paper over what probably would have been kind of more of a natural cycle recession that would have happened sometime in the last few years.
Agreed.
And we didn't see that happen, but we could be headed back that way as we take away, as the new Treasury Secretary, I think, used the words, there's going to be a detox period as we come off all of that in the economy. And that's kind of where I think we could be headed. And I think it could actually be a healthy reset of the economy and even the housing market to a certain extent. So that's kind of where I think we're headed.
So you're saying the yield curve was red, which would flash when it flashes red, like consumer sentiment was flashing red. The yield curve flashing red would indicate there's a recession coming. That often flashes red before the actual recession happens. Yep. So now it was no longer flashing red, it's flashing green, but there's this period where that recession actually takes place. And according to the Atlanta Fed, in the other slide that you showed, that was flashing that the recession is coming, that they're expecting it to come. So the yield curve takes some time to adjust. And so maybe this recession happens here in Q2. And then maybe it's a very mild recession. I don't think it's anything drastic. And even if it is, like, if it's mild, who cares, right? And Trump has said, look, we want the 10-year treasury to go down. We need to cut some of the government waste. So it's going to be more unemployment. The more unemployment there is, the more that the Federal Reserve is going to be kind of triggered to say, we have to lower rates, right? So to me, the domino is, I don't know how you feel, Darren, but the domino is, if inflation is in line or reasonable, then the Fed, if there's a big spike in unemployment, the Fed has reason then to lower rates, because that's the two mandates of the Fed, right? Is high employment and manage inflation. Employment and inflation, employment and inflation. So if employment starts to blip up, but inflation is reasonable at I think yesterday some CPI numbers came out and it was flashing 2.8% annualized, which is almost in line with their targets. So if unemployment can stay going up a little bit, but inflation stays in that 2.5% to 3% range, then they can justify rate decreases, right? Which would allow, again, more activity for borrowing, more activity for people buying for houses, those types of things as well. So those are your two numbers, man.
Rate decreases, I think. Yeah. Rate decreases. I think you might have said rate increases, but yeah.
Rate decreasing. You've heard what I meant to say. So rate decreasing.
I think, and there's room on, you look at the unemployment rate, we're at 4%. And it's up from last year, which is why I have it yellow. But 4% unemployment is not above the historical average of about 5%, what might be considered normal employment. So the Fed has some room there to wait a little bit and not be too aggressive on rate decreases, which helps with inflation. I mean, to me, inflation is bigger threat, and it's starting to get under control now. We're seeing signs that it's getting under control, but there is some wiggle room even on if employment went up to 4.5%, which is what, if you look at forecasts from Fannie Mae and MBA, they're forecasting unemployment rate of 4.3% by the end of 25, 4.4%, 4.6% according to MBA by the end of 2026. So even with that, it's not a catastrophic situation there. But I think what you laid out is exactly the path forward. And I think the path that, honestly, it seems like Trump is interested in following and getting those rates down. It would help the commercial space for sure with those folks who have the loans that are coming due, right? That there's not really a pathway out of those if you can't refinance it with a lower rate. And so that would help, and with the residential real estate market as well.
Yeah. It's a lot of stuff on your screen that's flashing yellow. Days on market, like everybody says, like there's properties that if it goes on the market, it's going to be sold in 4 days, right? And that seemed like more of the conversation last year, 2024. That's flashing yellow right now. So what is going on with days on market? Because that's yellow. Bankruptcy filings are yellow, kind of in the middle. 30-year mortgage rates are yellow. Unemployment's yellow. So is that all getting back to kind of the average at this point, or what? How do you interpret those?
Yeah, those are showing a little bit of weakness, is basically how I'd say. And if it continues in the direction that we're seeing with all of those, then we could get into red territory, and it could be bad. So the retail, looking at the retail housing market, days on market is a great signal there of once you start getting more inventory, that starts swinging more toward a buyer's market rather than a seller's market that we've basically been in the last decade. And that will put, in turn, potentially, if it continues, median days on market is not out of control, at least nationally. I'll show you maybe a heat map that shows where we're seeing it by market.
Yeah, I'd love to see it.
But the more inventory you have, the more it's going to put pressure on that home price appreciation piece, which is still green. And I think we are starting to even see some markets. I've got a lot here, but This is on the left-hand side there is housing inventory from realtor.com data. The I market. The yellow is where you're seeing the bigger percentage increase in active listings, which is similar to days on market metric. The yellow or orange there. So you see a lot of orange in Florida, in some other parts of the Southeast, really actually kind of through, if you squint, it's kind of through the Southeast and the Sun Belt where you've seen a lot of that inventory increases. And I just looked at I apologize, it's a little bit outdated, but just looked at the February data on this yesterday, and we're seeing the same patterns continue into January and February, where the inventories continue to rise, and that's going to put pressure on prices in these markets, especially I think in Florida, parts of Texas, parts of like Arizona and California. What's interesting is places like Cleveland, Ohio, and parts of the Rust Belt and Northeast are blue, meaning we are seeing some changes in inventory there, but it's not extreme, and we're not getting back to pre-pandemic levels yet there. And so inventory is still pretty tight, which is, it's kind of an interesting switch. Typically you see the Southeast and Sun Belt are the rock star markets where there's lots of growth, but it's a little bit of a reverse right now.
Yeah. I mean, historically, those were the markets that were the hardest to find deals, hardest to find anything on the market, anything listed with a realtor or anything listed, period, right? It was trying to find off-market stuff and a lot more on-market things in Cleveland and areas like that. But interesting to see Florida that there's rising inventory and probably longer days on market because simply more inventory. There's so many people that moved with all the COVID restrictions to Florida and to the Sun Belt, and there was all this population migration. Again, there was that kind of COVID period of 2020 through 2023, 2024. It's interesting to see. I think a lot of people see, wow, like we've seen so much appreciation. Things are starting to slow down. Maybe I want to catch this thing still relatively at the top and sell it before things pull back. Because at some point, there's just, a house that used to sell for $600,000 can only sell for $1.7 million for so long. It's like the houses in Naples and South Florida and Fort Myers and Fort Lauderdale, the prices literally doubled. Just a wild situation to see how much longer could that last? What kind of prices are people going to pay before they start to pull back? And I think they've seen the top now, and they're starting to pull back and put some inventory on the market. Darren, what do you think you're going to see over the next year or so with foreclosure inventory? And like, I know it's up, it's yellow, it's flashing, that there's going to be more, there's more bankruptcy filings. But relative to what? Like relative to history or historical times with foreclosures, is it a lot more? Is it still less than the norm?
Yeah, it's still less than the norm. I did want to start with where we're seeing a shift in that market, which is at kind of what I call the top of the distressed market funnel, which is delinquencies. And you said, definitely, I think the commercial market has led the residential market. We started to see stress in the commercial market maybe a couple of years ago, maybe last year especially.
Yeah.
We're starting to see that stress in the residential market in terms of seriously delinquent loans. So this is SDQs here. And this is data from the Mortgage Bankers Association. On the left there, in the third, I see in this data a shift, and it's pretty clear in the chart here, in the third quarter of last year, 24, where after 13 consecutive quarters where that seriously delinquent rate had been down on a year-over-year basis, we saw it rise, at least for FHA and VA loans, which are the most risky loans in our marketplace right now. Some call them the new subprime. I don't know if I go that far, but and then we saw another increase in the fourth quarter, which is the most recent data. And so that's a shift, upstream of foreclosures where these seriously delinquent loan rates are going up. These are people who are not just missing a payment, but missing at least 90 days plus late on their payments. And you definitely see it emerging with the FHA and VA borrowers who are more risky borrowers, more marginal borrowers. The MBA noted that the spread between FHA and and conventional and VA and conventional delinquency rates is growing. So, those FHA and VA loans are becoming more problematic relative to conventional, which is only Freddie loans.
So the FHA and VA stuff is like little or nothing down, right? And a lot of first-time home buyers, but little or no money down. 0% down on a VA loan, 3.5% down on an FHA loan. Sometimes it can be squeezed down even further with some kind of credits at closing. And look, who would be the ones that probably would have the most trouble with inflation, with prices going up? It would be those people that maybe are putting little or no money down, that are just getting under that debt to income ratio, 40 to 45%. They're able to buy as much house as they can with no money down. But then when prices go up, whether it's for gas or eggs or at the grocery store, or for just about everything, tuition for kids or for, clothes, everything seems to be up over the past because of all the money that was printed during the COVID years. Obviously, there was a lot of stimulus that was given out in 2021, 2022. As that burns off and you go back to your comment at the beginning of the detox, people are no longer able to subsidize those mortgage payments with government subsidies. Then now it's like, oh, wow, I don't have other money coming in. I'm getting squeezed by inflation, squeezed by the cost of gas, squeezed by the cost of my utilities, squeezed by the cost of insurance, all of which are up. That those people, the first
insurance is a big one for sure.
Yeah. First thing that goes, their insurance. I mean, not their insurance, but their mortgage. It's like, well, it's the biggest payment I have. I can't afford it. I'm still going to pay to keep the lights on. I'm still going to pay for gas and food and electricity in my car, but I can't afford this $2,000 a month mortgage payment anymore.
Yeah. Yeah. I think that's the picture that's happening with those borrowers. And, this is a different way to look at the distress market. So at the top of on the left-hand side, on the top of the funnel, the 30-day delinquent loans were back to pre-pandemic levels. I'm level setting this to Q1 2020 as pre-pandemic. So at the top of the funnel, we're at pre-pandemic levels. Now, just in the last 2 quarters, those SDQ, those 90-day delinquent, have come back to pre-pandemic levels. Those were running consistently below for the last 3 years, basically. But now that shift in the last couple of quarters has seen those come up. We're not now, to get to your original question about foreclosure volume, we haven't seen that trickle down to foreclosure inventory yet. So people are going SDQ. Now I would suspect that would trickle down to foreclosure inventory, but we're not predicting that's probably going to happen in big part this year. It'll probably more happen near the end of this year to the beginning of next year, where we'll start to see increases in actual foreclosures. And
I wonder, Darren, how much of those will actually turn into REOs because people have so much equity.
Yes. Yeah.
Right. They have so much equity. Like how many, there might be foreclosures. And if I'm a banker and I've got a loan for $300,000, but the house is appreciated in value, maybe I lent on a $350,000 purchase. I lent, 80% of that. So I lent $280,000 on $350,000. And now they paid it down a little bit, but now it's going to go into foreclosure, seriously delinquent. But the value of the real estate went from $350,000 to $450,000, and I'm owed $280,000 or $270,000, but it's in foreclosure. Man, it just seems like that homeowner would have so many options to refinance, borrow money, do a loan modification. And if I'm the banker, I'm going to kick the can down the road and modify the loan, go into some loan modification or forbearance agreement. Versus like 2008, when we were buying tons of short sales back then. The banks wanted to unload everything, right? Get it off their books. Now it's like, I have all these options to work with this homeowner.
Yeah. Because of that equity. So that, there's this record $35 trillion in equity, home equity. This is data on the left-hand side. I didn't cite it from the Federal Reserve. It is plateauing a little bit as home price appreciation slows down, but still tons of equity, and is including for these homeowners who are in foreclosure. So I think that's why we haven't seen it's taken longer, or we haven't seen the delinquencies flow to foreclosure as rapidly or REO as before. We see on the right hand side, we see not surprisingly, a very close correlation between equity and what we call our brought to auction rate. So the percentage of properties that are scheduled for auction, foreclosure auction, that actually go to auction. That's the green, or that's the blue line. And that's been coming down consistently, except for a blip there in 21 having to do with the foreclosure moratorium.
Yeah.
That's been coming down as LTVs, which is the inverse of equity. That your LTVs have been coming down, so people have more equity, and so they're able to avoid foreclosure. So yeah, I think that's why we're conservative in saying these delinquencies are not going to necessarily translate into a huge glut of foreclosures anytime this year, for sure. We have 3 scenarios here where we're saying, this is not just auction.com, this is nationwide. There were only 75,000 completed foreclosure auctions last year. That's, as you can, I just put 2019 there to put it in context. In 2019, which is not a huge foreclosure year, there were 210,000. So we're this really low level of foreclosure.
Recession. Wasn't there like 2 million?
Yeah, there were over 2 years, 2009 and 10, where there were over 1 million each year.
Each year. So, yeah. Wow.
Yeah. Like 1.2, 1.3 million. So yeah, we're in this almost abnormally low level of foreclosure volume. We do see, especially if the red scenario there is like our worst case scenario for this year, is if home price appreciation nationwide slows down to 2%, unemployment rate ticks up a little bit, averages 4% for the year, or was under 4% last year. That would result in 99,000, which is still below what we saw in 2019. So that's where we see it. I mean, this is not definitive, but we do see, on one hand, we see the winds shifting where these delinquencies are coming up. More people are getting into trouble. Some of those especially recent vintage loans don't have a lot of equity, even though overall there's a ton of equity. So those recent vintage loans, 2022 plus, are more at risk. So I do think eventually you'll see this corresponding uptick in foreclosure volume, but it's more likely to occur next year.
Yeah. So predict the market, Darren. Put your magician's hat on and rub your crystal ball. And what do you think happens maybe over the next 2 years with all the government stuff, Doge stuff, unemployment rates, foreclosure starts, bankruptcies? Nobody's going to hold you to this, but what are your thoughts?
You'll come back and play the recording. Yeah, I do think we're in your room. That's right. I think we'll see this kind of reset or detox a little bit coming off of a period where there was just a lot of government stimulus, and getting off of that, there'll be an uncomfortable period this year, potentially where and I think a recession is becoming more and more likely this year, and at least in many markets and possibly nationwide, a home price correction this year that will start to reset some of these values, especially in markets that are overinflated. And that will, to me, that does spell more opportunity for investors. Now, I think you kind of described this earlier. It's going to be this period where it's scary to invest. It feels scary to invest because the knife is falling situation.
Sure.
That's and you don't want to catch that falling knife, right? But I think that actually, in hindsight, when I talk to a lot of investors, they wish they had bought more during those periods. And I think there's a good possibility of one of those periods coming up this year where you'll see prices in a lot of markets coming down, opportunities to buy. You'll see more volume, especially near the end of this year and into next year, more volume of distress, which is also scary. But that if you're willing to take the plunge and buy in that environment, coming out the other side, as you talked about earlier, you'll be in a good position.
Yeah, I agree. I think it's one of those markets where, like just high level. Rates are still high. Inventory is going up, but not that much. Days on market are going up, but not that much.
Yeah.
Long term, I think we're going to continue to see home price appreciation in most markets, except those markets that are so overinflated, maybe like Austin or Orlando or Phoenix. Those kind of places feel like they have to come down a little bit, still. But to me, it's a market where I like the normalcy of it, because if you look back, it would be great to see all these statistics, Darren, and say, okay, we're comparing, right now to the previous month to the previous year. But it would be great to see them compared to the 30-year average or the 15-year average, and then you're like, okay, how does this compare to economic history, maybe from 1980 or 1990 up until now? And what does that the median feel like? Because
Actually, I love that. I think I'll take that suggestion. Add another line. Not that this side needs more data, but add another line that says, what's the 20-year average or something like that.
Yeah, that would be great. Because then you could say, okay, where are we at relative to the 20-year average? Because every economy goes in these cycles. Normal economic cycles are usually about 7 years. You have a run up and then a recession. Sometimes different, depending on who you talk to, would say there'd be a recession roughly every 4 to 5 years. Then it was 7. Now we haven't had a recession in 15 years. It's really been bonkers because of what happened with COVID. But, take that COVID into play and then also massage in the foreclosure crisis of 2008. And if we were able to go back to let's say 2000, right? Because then you have the stock market crash of 01. And how does all that data blend together over 25 years? And then say, how does it feel? Because to me, it still feels like the economy is strong. Trump is trying to bring jobs back home, energy back home. That's going to create more opportunity for folks. There's some distress in the market, but people have a ton of equity. And the majority of people have, a mortgage interest rate below 5% or even below 4%. Those are all positives for the market. A lot of companies have announced that they're bringing work back home. They're onshoring jobs. They're onshoring manufacturing. That's good. And so although we might see some blip in a recession and maybe egg prices are high in the short term or there's inflation in the short term, I don't know how anybody could say that the economy doesn't feel like it's going to still be good for the next, 3 to 5 years. I don't know. I don't have a crystal ball either, but I think it's going to be where investors, whether it's a stock market investor, a real estate investor, a commercial real estate investor, is still going to have to search out and find value. They're going to have to do their own analysis. They're going to have to look at every deal. They're going to have to see, like, how can I value engineer this deal to make money? And some deals you just can't make money because they're overpriced. And stocks, you can't make money because it's overpriced. It's going to come down to the operator. It's going to come down to the investor to make their own decisions, create their own business plans to make money. In other words, the market's not going to make money for people. It's going to have to be a situation where you make your good decisions. It's going to be, to me, the next 3 to 5 years is going to be the years of the operator, the year of the investor who is not just riding the coattails of COVID or riding the coattails of low interest rates or riding the coattails of tons of foreclosures. They're going to have to be skilled at looking at individual deals and making those decisions in a small silo. Is that a good deal that I should invest in? And how am I going to exit that deal to make money? Am I going to cash flow it? Am I going to sell it? Right? Can I find something at a discount, maybe off market? Like, that's going to be what's happened to me in the next 3 to 5 years. It's not like, hey, I'm just going to be able to buy something super cheap, make some small improvements, hopefully get low interest rates, and the prices are going to skyrocket. Crypto is going to skyrocket. The stock market's going to skyrocket. All that has already happened, right? So I don't think it can just continue. It's going to have to be something that somebody is a skilled investor that makes good decisions.
I think that's right. I mean, I do think that there'll be with this kind of reset detox period, there'll be a little bit different opportunity than there has been over the last few years. But you're absolutely right. At the end of the day, it's about adjusting. You do adjust your strategy to the market, but you still need to operate. You still need to run your numbers on every deal and do your due diligence and do everything. It's that discipline that's going to the continued discipline, which may shift up or down depending on the market conditions. But still, it's you got to keep doing this. I pulled up this screen because we did a buyer sentiment survey of our buyers who are out there. They're usually the local operators, as you say. We call them local community developers who are buying, anywhere from a couple of properties to, maybe 50 properties a year. They're but relatively small, but they know their markets very well. I just love some of these quotes. Like the second quote here, the price of everything has increased, including foreclosures. However, as long as profit margins stay the same, it doesn't affect me much. Our question was, how is the market affecting you? That's, I think, that's the sentiment that we see with a lot of our buyers is, the market, we do shift with the market, but we still keep that disciplined investing approach that we have, and we can still make money in any market.
Love it. Love it. I'm finding more foreclosure properties on which to bid. So that's good. Low inventory is pushing us out, pushing us to other markets. It makes sense. If there's no inventory, tough to find. I look mostly on the local market without paying attention to the entire market. I'm a little less aggressive than I was several years ago, but that is determined by my local market. I think all of that resonates with me. That's why we've decided, we're going to focus on just investing in our own backyard because it's what we know well, versus so many people in the commercial space, especially, they maybe lived in California, they lived in Chicago, they lived in New York, New Jersey, and they were buying properties in Austin or Dallas or Phoenix or, Southern California, Nevada, Orlando, those gateway Sunbelt markets. And all the data said, oh my God, rents are going to keep going up. Then all of a sudden I see rents in Austin are down like 15% because there's so much inventory. So I think the lesson for me is, it's always going to be local. Real estate is very local. When you see headwinds or you see not headwinds, but headlines on the national news, I don't put any stock in that at all. Because you have to be very, very local to what you're investing in and understand not only just Cleveland or Columbus or Atlanta, but even your neighborhoods within those submarkets. So submarkets in a city and then neighborhoods within a submarket. Man, like we only invest in really 2 or 3 submarkets in all of Cleveland. And even there, it's a few neighborhoods. It's a few areas within those submarkets. So even when data comes out about Cleveland, it's like, well, that's not really relevant to me because I'm in just these submarkets and just these neighborhoods. That's how I think people win in the next 3 to 5 years.
I love that. Yeah. And that resonates with a lot of when I talk to our buyers, they know that little hyper local market super well. And better than anybody else, that's their market. And when that's the case, they tend to do very well.
Awesome stuff. Darren, listen, I know a lot of our folks have been following you for years. You've been speaking on our stages and on our podcasts and webinars for at least 5 or 7 or 8 years. So I appreciate all the time and attention you put into our community. Again, just tell our listeners and people who are watching maybe on YouTube, where can they go get more information about auction.com and more information to follow about all this amazing information that you put out to the public?
Yes. Auction.com, go there to explore the inventory that we have available across the country. And then auction.com/in the news is where I post all of my research and analysis, heat maps like these. And we have a auction market dispatch that we put out every quarter that has a lot of these aspects, these slides that I've shown today. And so, yes, definitely. And on LinkedIn, follow me. Feel free to follow me there. I did want to just mention a quick pitch is we just launched that may be of interest to some of your audience. We launched a new product called Smart Sale that allows individual sellers to post their properties for sale on auction.com. In the past, it's been pretty much all banks and mortgage servicers, properties that we're selling. Now individual sellers can, and we do see a lot of investors interested in that and selling some of their properties. So go to smartsale.com or just go to auction.com and click on sell with us if you're interested in that. Of course, that means more inventory for our buyers too. So that's the flip side of that point.
Awesome stuff, Darren. Thanks so much for being here today. We appreciate you. We'll have you back in about 3 months and we'll see what happens between now and then. Thanks for being here.
Thanks, Josh.
Rust off for me. It's been a minute since I've done some podcasts. This last couple that I've done, I feel like I'm getting back in the groove, man. So thanks. I think Jen's got us scheduled up again 3 months from now, so we can jump into that. How are things otherwise? How's business for you guys? How are you? How's your family?
Family's doing great, doing well. I guess as I'm getting older, I've had a few health issues the last couple of years, but feel like I'm coming out the other side of those. So that's really good. We're plugging along. It's not the best market for us either. Kind of like what you're saying. If we stay disciplined, we can do well in any market.
Yeah.
So that's where we are.
So with your health journey, are you following anybody? Like, is there anyone that you're following along to like?
Not really. I feel like I should, but if you have any recommendations, but it had to do with I had this issue with my neck where my neck was pulling. It's called cervical dystonia, where my neck was pulling to the right constantly. I think I've figured out some things. And there was, my wife and I did Whole30 in January, and that seemed to really help along with some other things I'm doing.
Whole30.
So that's Whole30 diet. If you can go on it, there's a bunch of restrictions